Welcome, everyone. It's the 31st of December in 2022. I know it's been a challenging year for many investors out there. And so I thought I'd do a presentation, how to deal with losses, lessons from billionaires. And these are some of the techniques that I use to help me cope with when things don't go as planned. So first up, this is meant to be thought-provoking. It's not advice. Please do your own work, read the disclaimers. Email clientservices@randallfunds.com if you'd like a copy of the disclaimers. The first point is the future is uncertain. Don't expect 100% hit rates. We've got the weather map here. A 5-day forecast can accurately predict the weather about 90% of the time. 7-day forecast, about 80%, and a 10-day forecast about half the time. And that's with all the computers and the AI and the satellites and the algorithms, etc. They only get it right half the time. If you look at some professions, a study of Queen's Counsel, who barristers at the top of their game, they win about 55% of their cases. Doctors, as we know, unfortunately, don't get every diagnosis right. Sachin Tendulkar, one of the greatest cricketers in the world, who's scored 49 one-day international centuries, has also gone out on 20 occasions for no runs. You know, Roger Federer at an Australian Open match a few years ago, he had 82 unforced errors. And when asked about it in the press conference afterwards, he said, look, a 4-hour match, you are going to hit unforced errors. So we're going to make mistakes, all of us, no matter what profession you're in. The point is, what do we do about them? Okay, well, you have to minimize your losses here, and here's why. Here's $100 or 100. If you lose 10%, you have 90. Your required return is 11%. Take that 90 back to 100. If you lose 25%, you've got to go up 33%. If you lose 50%, your 50 has to double to get back to where you were. And so if you look at a chart over here, your loss suffered on the x-axis, your required return on the y-axis. Okay, you want to stay away from these areas on the far right because it goes exponential. If you start losing 80, 90%, anywhere over sort of 30%, it starts getting exponential. So you want to stay away from that side of the chart. But how do you do that? Well, you do that with margin of safety, adopting a margin of safety approach in your investments. Because rule number 1, never lose money. Rule number 2, never forget rule number 1. So as we sit here and review 2022, please be honest with yourself. If you buy shares directly, do you have a disciplined process that brings into that process margin of safety? Do you have a spreadsheet for each company that you own? Do you know what the company is worth? Do you have an idea of what you think the company is worth? How are you going to respond if things that are unexpected happen? Okay, so do you invest with a margin of safety? Are you sufficiently diversified? Do you have enough shares in your portfolio to be diversified? And I'm not talking about 4 or 5, because that means you've got 20% positions, and large positions are very difficult to manage emotionally. And do you have the time? So if you have to have more than 4 or 5 positions, do you have the time? You must realize that you are investing in the best in the business. I can't go play tennis with Roger Federer tomorrow, but every day my portfolio is out there competing. I'm competing with the best fund managers and hedge fund managers in the world. It requires 24/7 devotion. Now, what about the funds? Are you invested in funds where the margin of safety is integral to the fund manager's investment philosophy? And you will know the answer to that by looking at the performance in 2022. Just look at the performance. If the fund is down a lot, well, margin of safety doesn't feature high on their importance. So what changes do you need to make in 2023? And let's look at what some of the billionaires tell us. So here's Paul Tudor Jones, one of my gurus, worth $7.5 billion. And how does he suggest we address errors? If you have a losing position that is making you uncomfortable, the solution is very simple. Get out, because you can always get back in. And he says, don't be too concerned about where you got into a position. The only relevant question is whether you're bullish or bearish today. Okay, it doesn't matter where you bought your share or your fund. If you are down substantially and you think the future has changed, well, take action. Just focus on where you are today and what is the right decision going forward from this point. What does George Soros say? 6.7 billion. It's not whether you're right or wrong, but how much money you make when you write. and how much money you lose when you're wrong. And he says, I'm only rich because I know when I'm wrong. I basically have survived by recognizing my mistakes. So here you've got billionaires, telling us how they act when they have errors and they recognize they have errors. Here's Bruce Kovner. If you can't take a small loss, sooner or later you will take the mother of all losses. We don't want massive losses. We're on the right-hand side of the chart we saw earlier. Now, if you look at those three, and there are many others, feel free to Google them, you will see there is one common thread. Rip the weeds out. Rip the weeds out is what you have to do. You go, but hang on, Sean, I thought we had to buy and hold. Well, you need to read the fine print. What Warren Buffett said, he said, when we own portions of outstanding businesses and outstanding management teams, our favorite holding period is forever. He didn't say our only holding period is forever. It's our favorite holding period. You think he doesn't sell shares? Of course he sells shares. But you need to understand that outstanding businesses can change. Outstanding management teams can change. Conditions change. Prices change. And what does that mean? It means potential returns change. Now, must we never change our portfolio when potential returns are changing? Of course not. And look at what they've done. So here's investors.com analyzed some of the sales from Berkshire Hathaway, just to prove the point that they do sell. In 2022, they dumped AbbVie and Bristol Myers and Royalty Pharma, not long after acquiring them. In 2021, they sold Biogen and Merck and Teva. Okay. In 2020, they bought and then sold Pfizer and Barrick Gold. They sold Costco, as well as all of its airline stocks amid the coronavirus, and we'll come back to that in a sec. They sold USG in 2019, IBM in 2018, General Electric in 2017. Why did they sell? I don't know the reasons, but some of those factors that I spoke about earlier, about management teams and business and conditions and prices, would have played a role. Now, what happened in 2020, Berkshire Hathaway sold all its airline stocks because of the coronavirus. And this is from the same article. The price stake worth north of $4 billion. They exited $4 billion. Why? Because the world had changed for the airlines. Now let's just stop and think about it. The world has changed. That was their reason for selling. Okay. Sometimes there are events that necessitate quick change. And what did they do? When we sell something, very often it's going to be our entire stake. We don't trim positions, is what Warren Buffett said. So now the question is the world changed? Well, this is an upside down map. I think it's changed, gone from low inflation to high inflation, low interest rates to rising interest rates, offshoring to onshoring, stability to instability. Okay, and when the world changes, what should we do? Well, this is a chart of MSCI World Value Index divided by the World Index. Value has outperformed for the majority of time. Why? Because value investing simply makes sense. Okay, it underperformed when we had after the global financial crisis. Why? Because of quantitative easing and lower interest rates. And that is what facilitated the rise in many of these companies that have done well, the Amazons and Teslas of the world. Okay, but now that period is over. The world has changed, and value investing is now having its day in the sun again. Values are performing as it did after the 87 crash, as it did when the bubble burst in 2000. Okay, is their performance over? Well, don't take my word for it. This is GMO, very, very highly respected fund manager. Jeremy Grantham is an absolute guru. Do you see what he's been saying in recent months and years? And he says value equities are still priced for significant outperformance globally. That was their third quarter. Let's take another investor's view. This is Dan Lube. What did Dan Lube say? I don't think camping out in the last decade's darlings with rosaries in hand, hoping for a comeback, will be the winning strategy. We have already seen the revenge of the value nerds. I think there's more to come. And I'm one of those value nerds. I think there's more to come. And he said this recently on the 26th of December. Now, who is Dan Lube? He is a billionaire investor and philanthropist in America. Okay, somebody to pay attention to. So the question is, how are you responding to a changed world? Are you responding like this? Are you putting your head in the sand, hoping the problem goes away, hoping that 2023 is going to be nothing like 2022, hoping that you don't get driven over by your big position? Always tricky to manage big positions, and they can drive you over, and emotionally you won't deal with them. And if they do, you've got that mother of all losses that Bruce Kovner is talking about. Okay, something I find quite useful is I pretend my cat has walked across the keyboard and sold my entire portfolio, our entire portfolio, and then I look at it and I go, which positions would I buy back, and at what size? And I call that a portfolio pet purge. And it's pretty similar to what Paul Tudor Jones talks about. And this is what he says. He says there is nothing better than a fresh start. So why don't you apply that to your portfolio? Look at your funds, look at your stocks, pretend it was all in cash. What would you buy today? And that would be the advice of Paul Tudor Jones, a billionaire. So I hope you've enjoyed this. I hope you've learned something. If you do, or if you have done, like, comment, share, and subscribe. Share it with if you're an advisor, share it with your clients. If you're a client, share it with your advisor. And here you can see if you want more information about us, you can find information on the website, randmorefunds.com. I write quite a lot on LinkedIn. Numbers, not narrative is my hashtag. You can also find more information about our performance on Morningstar and the FT. And wishing you all the best for 2023. Hopefully our paths cross, and I hope you've enjoyed this.